Rates stabilize, inflation is still hot, and the return of adjustable rate mortgages. This is the weekly report on Major Money Matters. All right, welcome to the weekend. This is the weekly report on Major Money Matters. This is where we update you on what happened this week in mortgages and in economics and things that may be affecting your home buying or potentially home selling process. So if this is your first time here, I encourage you to hit the like button, hit the subscribe button so you get updated when we post weekly videos to keep you updated on the housing market. Okay, let's start off with the charts, and I think we've kind of stabled out here in rates. Now, day to day, you may see some fluctuations in pricing, but compared to where we were previously and from like November on till maybe April, the beginning of April or so, I will take this any day. So you start to see some stabilization, you see some lateral movement, and not as much downward sloping movement. So all things considered, I think we're in a good spot. Now, the numbers for inflation in the month of April came out. This data lags behind a little bit. So the numbers for inflation for the month of April came out this past week, and those inflation numbers were still hot, but they were not as hot as they were in March. So therefore, what you started to see is the bond market started to really respond to that. Although the Fed increased rates, I've told you before, the main driver of interest rates is inflation, not the Fed raising rates. So that's why you start to see some alleviation, at least temporarily, for interest rates. So we're starting to balance out. So where are we? Generally, average interest rates across all programs, okay, are currently about 5.3%. Now, that's not necessarily currently because that data lags behind a little bit. These are loans that are closing. So these are loans that would have been locked maybe 3-4 weeks ago. And so we're at about 5.3% on average across all programs, all points, all fees. This is all programs just looking at the interest rate. So about 5.38%. You know, I've told you guys if you're in a government loan or something like that, you might be able to get a lower rate than that. Rates right now, man, rates kind of took a dip this week. I was able to get some people locked in on jumbo VA in the low 4s. So sometimes, depending on the day, depending on the pricing, depending on the investor, you might be able to get a good deal. But in general, interest rates are kind of balanced out here, and we're in a pretty good spot. Remember, go back to my video from 2 weeks ago, and I told you that I think this is the calm before the storm. I think we're going to see another jump in interest rates around the July, August, September timeframe before things start to taper off. Okay, the other thing, inflation, as I told you, inflation continues to be a hot topic near a 40-year high. But what are people doing about it? And I found this interesting because they put out this survey about what people are going to do because of higher prices. And the question is, which of the following, if any, will you consider doing if higher prices persist? So which will you consider doing if higher prices persist? And this is interesting because people talk about higher interest rates affecting the housing market. And really, higher interest rates are affecting the housing market. There are some buyers that are taking a look at certain things. Maybe they're buying, but they're buying at a lower price point than they would otherwise have bought with lower interest rates. So they're making some adjustments. But look at where delaying buying a home ranks on this chart. Delaying buying a home is like number 8 on this chart. So people are going to cut out dining out. They're going to cut back in driving. They're going to cancel a monthly prescription, switch to a generic product. Then comes delaying buying a home after delaying buying a car. So this chart, I found this survey interesting because this really speaks to the resiliency of buyers right now in this market, even with higher interest rates. we're still seeing people go out and buy homes. Now, the question comes, how are they buying those homes? And this is interesting because for conventional buyers, now VA, most of the time an ARM doesn't make sense because your rate on a VA on a 30-year fix is likely very close to where you would be on an ARM, plus an ARM requires a down payment. VA doesn't usually require a down payment, but you can put a down payment down, or FHA requires a smaller down payment than an ARM would require. But adjustable rate mortgages are at a 14-year high demand. Now, people say, wait a minute, they're doing adjustable rate mortgages again. It's just like 2008. Adjustable rate mortgages are back. It's going to crash the market. Adjustable rate mortgages is the worst thing ever. That's not true, okay? Today's adjustable rate mortgages are fully underwritten products, okay? That was not true in 2008. Also, adjustable rate mortgages have a fixed term. You can have them fixed for 5, 7, or 10 years. Interesting side note, as some people found out painfully this week. Fortunately, I did not have a doctor loan that was in underwriting. A doctor loan is essentially a portfolio loan. That's a adjustable rate mortgage for doctors. The problem is when this program came out for doctors exclusively, you had to have a doctor's degree, a medical doctor. When this program came out, the investor received $500 million in requests for those loans, so they had to end that program. Some of those programs were ended while people were actually in underwriting on doctor loans. So very unfortunate, but that's a version of ARMs. And we're starting to see these come back. Sometimes that pricing can be very, very attractive when you have a conventional rate that might be in the mid-5 ranges, and you can get an ARM in the mid-4 ranges. Pretty good product to take a look at if the product makes sense and if you could stomach the risk. Why are people going to these ARMs? Because most people believe that we're trending into a recession and they're going to refinance anyway. So the ARM is a good temporary product, especially if it's fixed for 5, 7, or 10 years. Last thing I want to share with you before we end up here. Higher mortgage rates set stage for lower home sales. Now, the headline is sort of misleading here. People are thinking that they mean lower home sale prices. That's not what they're saying. They're saying lower home sales. And to be honest with you, look, there are people who are in 2% interest rates, and they're saying, look, if I sell my house and go get another house, I'm paying an interest rate in the 4s or in the 5s. I'm comfortable right now. I can stomach this. I can make this work for a little bit longer and see if interest rates come back down. So those interest rate decisions affect their selling decision and their move, whether they move up a buyer or something like that. So that may affect their decision. So that's a lower amount of home sales. Plus, there is the fact that higher interest rates temporarily may drive some people out of the market. So that might mean lower home sales, but we still have a supply and demand issue. That supply and demand issue is creating upward pressure on home prices because there's simply not enough homes for the people who want to buy homes. So you're going to continue to see this upward pressure. Now, back to interest rates. Now, I've told you that I believe interest rates will increase through the summer, through July, August, and September. I believe we're going to see that because of inflationary numbers that are coming out in those months, replacing the lower inflation numbers that are currently on the books. So you're going to see higher inflation numbers, and I think you're going to see another interest rate bump. Best thing you can do, if you're a buyer right now, lock and shop. Best thing you could do if you're a realtor and you have clients that are buying in the next 4 months or so, 3 to 4 months, tell them to lock and shop their rate now. Okay, you can go look at my video on Lock and Shop, the one that talks about the most powerful tool for home buyers right now in this market. Take a look at that video and get some information on Lock and Shop the way we do Lock and Shop. I believe it's the best way to do it, not paying an upfront cost to lock in a rate. That's stupid. Shouldn't do that. But you can lock in a rate at one investor, and then if rates go down, which frankly, I locked and shopped some people a couple of weeks ago, and I was able to get them a better rate. someplace else. So I moved their loans over when I got a couple of contracts in this week. So you definitely can do that. Lock your rate now and then move over to a different investor if you're working with a mortgage broker. So there's opportunity there. So that's it for this week. See you guys next time on Major Money Matters.